There's a lot happening in the markets right now, and everyone's talking about it. YouTube, TikTok, podcasts, X, the business press, it's all noise all day. Crashes, inflation, debt spirals, the AI bubble, crypto falling apart again, it's everywhere. And at the same time, people are sitting at their kitchen tables doing their own maths, working out why the rent went up more than their pay rise, if they got one, why groceries cost more every month, why their savings don't feel like savings anymore. You don't need to be an economist to tell you something's off. You can feel it. That feeling's not confusion. It's the feeling of financialisation. But here's the thing. For all the talk, the opinions and predictions, we're having the wrong conversations. We're obsessing over the symptoms and ignoring the cause. The financial system no longer reflects the real world, it dictates to it. There was a time, and not that long ago, when capital followed a fairly simple loop. You invested in something real, people got jobs, communities grew, and the prosperity that came out of it flowed back into the everyday economy, into wages, shops, services, and places people actually lived. But over the past 40 years, that loop has slowly come apart. Factories closed, but asset prices soared. Wages stagnated, but markets climbed. Companies stopped reinvesting in workers and started reinvesting in their own share prices. Capital didn't disappear. It didn't even stop building things. It's just that building things stopped being its main purpose. More and more, capital turned inward and started building on itself. Money began making more money, not through new production or innovation, but through leverage, speculation, and layer upon layer of financial engineering. Whole sectors shifted from creating value to extracting it. But today, the most important part of that story doesn't involve companies at all. It happens far above the real economy, in the invisible plumbing of global finance. And to understand how that plumbing came to dominate everything, we have to go back to the moment it was rebuilt. In 2008, when the financial system blew itself up, we didn't let it collapse. We rescued it. And then we rebuilt the entire architecture of money in a way no civilization in history has ever attempted. 0% interest rates, trillions in quantitative easing, a permanent safety net under asset prices. Then something extraordinary happened. A tiny group of people, the people closest to the financial fire hose, experienced a wealth expansion so extreme that you have to go back to Mansa Musa to find anything comparable. Not wealth for living, not wealth for comfort, wealth so large it distorts markets around itself, the way Musa's gold caravan destabilized whole economies just by passing through. It wasn't an accident. It was the consequence of the world we built after 2008. Zero interest rates, trillions in QE, oceans of liquidity with nowhere real to go. The behaviour that followed was predictable. And the carry trade, the one running through the entire global system right now, is one of the clearest examples. To understand how this works and why it matters now, we have to go back to where it started. For decades, the most profitable thing in global finance hasn't been innovation or production. It's been borrowing money cheap in one place and using it to buy high-yielding assets somewhere else. The most important example of all of this is the yen carry trade. And to understand it, we need to go back a little, because this didn't start last week or last year. It's been shaping global markets for almost 30 years. It begins in the mid-1990s, when Japan's great economic bubble collapsed. Property crashed, stocks collapsed, and the banking system broke. And Japan slipped into something the rest of the world had almost never seen before: deflation. To fight it, the Bank of Japan kept cutting rates until, by 1995, money in Japan was essentially free, 0% interest, and it stayed that way not for a year or two, but for decades. And once you do that, something predictable happens. People start borrowing yen, the world's cheapest money, and using it to buy assets everywhere else. That's the yen carry trade. You borrow yen at close to zero, you convert it to dollars or euros or Australian dollars, and you buy something that pays 4, 5 or 7%, sometimes more, and you pocket the difference. It's simple, it's logical, and at scale, it's enormous. In the early 2000s, it began to swell. Japan stayed at zero, the rest of the world offered real yield, and global risk appetite was exploding. The yen carry trade became one of the engines behind the big booms of that era. Emerging markets, commodities, Australian New Zealand housing, hedge fund leverage, corporate debt, you name it. But then 2000 hit. Markets panicked. Everyone tried to unwind their yen loans at once, and the yen spiked violently, because when you borrow in a currency and that currency suddenly strengthens, your debt explodes. It was one of the hidden accelerants inside the GFC. You'd think we'd have learned from that, but instead something extraordinary happened. In 2013, Japan doubled down on zero rates. It then added its own version of QE. Massive, open-ended and relentless Abenomics was born, and the yen became not just cheap, but intentionally suppressed. That supercharged the carry trade, and it became one of the foundations of global finance. But then, during COVID, the rest of the world joined in. The US printed trillions, Europe printed trillions, the UK printed trillions. Everyone went to zero. We flooded the planet with cheap money. And when the pandemic ended and the US and Europe raised rates sharply, Japan didn't. Japan stayed at zero. Japan kept printing. Japan became the last cheap lender in the world. And that opened the door to the most profitable carry trade in modern history. Borrow yen at almost nothing and lend it to the United States at 5%. Free money at global scale. Trillions of dollars moved through that gap. Trillions. And here's the problem. What cheap money gives, rising rates can take away. If the yen strengthens suddenly, or if Japan finally rises its rates, the whole structure can flip. Debts grow, positions unwind, and the same trade that pushed markets up becomes the force that drags them down. This is why the yen matters. This is why a tiny change in one country's interest rate can shake the global financial system, because the world rebuilt itself on cheap liquidity, and Japan became the last open tap. But here's the real problem. All of this activity, all of this money, it creates nothing. No factories, no job, no innovation, but it does do something, and something enormous. It pours vast profits into speculative, non-productive assets. Because when you can borrow billions at near zero cost and leverage that position 10 to 1 or 30 to 1 into high yielding bets, you generate profits on a scale that no ordinary business, no workshop, no farm, no tech startup could ever match. And those profits don't flow into industry, they don't flow into wages, and they don't flow into communities. They flow into speculative asset markets. Bitcoin and crypto, tech megacaps, luxury property, private credit and shadow banking funds, NFTs and meme assets, and commodity supercycles. None of this is productive growth. It's the recycling of leveraged profits into speculative asset inflation. And that inflation spills into everything. Housing becomes unaffordable, rents rise, retirement gets harder, inequality accelerates, and the stock market becomes detached from the lived reality of most people. This is one of the main engines of the modern everything bubble. It's financialisation in its purest form. A system where the highest returns come from manipulating capital, not building anything real. And right now, that entire machine is under stress. The Bank of Japan has signalled that it might raise rates even slightly from 0.5 to 0.75%. That tiny, barely noticeable shift has rattled global markets, because when everyone is on the same side of a giant bet, a small movement becomes a shockwave. And you've seen the signs: Bitcoin liquidations, sudden drops in risk assets, volatility creeping into the S&P, hedge funds scrambling. This is invisible systemic risk finally becoming visible. But this risk isn't about the size of any one fund or operator. It's about interconnection. Just 12 major institutions account for 78% of all bilateral exposures. A bilateral exposure exists when two institutions are counterparties to financial contracts, usually derivatives, where money can flow in either direction depending on how the contract moves. So it's not a loan, and it's not a simple debt. It's not just I owe you, you owe me. It's this: we have a long-term contract whose value keeps changing. And depending on the market, one of us could suddenly owe the other a very large amount. That's why it's dangerous, because the obligation is conditional and can change rapidly under stress. And the problem here is, after 2008, the biggest players learned if you're big enough, the government will step in. If you're interconnected enough, taxpayers will absorb your losses. That creates moral hazard, taking big risks because someone else will pay if it goes wrong. It's rational for each actor, but collectively it builds a system designed for collapse. Now, this needs to be said. Defenders of the system say markets allocate capital much more efficiently than anything else. So, let's check the scorecard. After 2008 and QE, where did the capital go? It went to derivatives, carry trades, arbitrage, and financial engineering. Where the capital didn't go was jobs and wages, resilience, infrastructure, climate adaptation, or domestic industry. Markets optimize for the rules we give them. Right now, the rules optimize for extraction. This is the moral inversion. The activities that sustain society are less profitable than the activities that destabilize it. We didn't end up here by accident. The system we have today was built through choices. Political choices, regulatory choices, cultural choices, and because it was chosen, it can be re-chosen. We're not trapped. A different path is possible, not instantly and not perfectly, but deliberately. Here are the pillars of that path. Number 1, make speculation expensive. Not all speculation. The world needs risk takers, but hyperspeed, zero-cost micro-trading. It does nothing for the real economy. It creates no value, adds no stability. It simply extracts profit from being faster than everyone else. We can change that. Add a tiny financial transaction tax, fractions of a percent. It would slow the pace, reduce the noise, and favour investment over machine-driven churn. It protects market function without punishing long-term investors. Speculation isn't evil, but when it becomes the dominant activity, it distorts everything around it. A well-designed tax resets the balance. Number 2, constrain leverage, because leverage is the accelerant. Leverage is the magic word behind every boom and every crisis. It turns a good idea into a windfall and a small mistake into a catastrophe. The problem isn't leverage itself. The problem is unbounded leverage. Layers of borrowing stacked on borrowing, amplifying risk until nobody knows where the real exposure is. Fixing this is simple engineering. Higher margin requirements, lower leverage caps, stress tests based on real-world scenarios, not optimistic models, more capital held against risky bets. A system with bounded leverage can wobble. A system with unbounded leverage can collapse. Number 3, we have to separate deposit-taking banks from speculative trading. There's a reason we used to have a wall between savings banks and investment banks. It wasn't ideology, it was basic risk containment. when your savings, your mortgage and your paycheck sit in the same institution that's running a synthetic derivatives book, one bad bet can take down the whole house. We can rebuild that separation. Let speculation happen, but let it happen in institutions designed for it, capitalised for it, and allowed to fail without dragging the public down with them. People shouldn't lose their homes because a bank lost a swap. Number 4, put derivatives into central clearing where everyone can see them. This is one of the strangest failures of modern finance. The biggest market on earth, the derivatives market, happens mostly in the dark. If you and I could write a $10 billion swap, nobody else sees it. No regulator, no central database, no clearinghouse. No one knows who owes what until something goes wrong. Central clearing fixes that. It standardizes contracts, it verifies margins, it guarantees payment, and most importantly, it gives regulators and institutions a real-time map of the risks in the system. It's not about stopping speculation, it's about making it visible, and what is visible can be managed. Right now, we're flying a $1 trillion aircraft with the instrument lights turned off. These aren't ideological reforms. They're engineering corrections. We built a machine that funnels capital into speculation. It amplifies leverage and it hides risk. It socializes losses. But machines can be rebuilt. We can choose a system that does the opposite. It rewards investment over churn, limits leverage to what the real economy can support, protects savings from speculative blow-ups, and illuminates the risks instead of burying them. It isn't utopian, it's not even radical. It's the kind of plumbing work we should have done after 2008, but didn't. And the longer we wait, the more expensive the repairs will become. People can feel instability long before they can explain it. You see it in your bills, you hear it in your friends' voices, you feel it in the background of everyday life. The headlines might say growth, but growth for who? Markets might be climbing, but most people aren't living any easier, and that gap between the symbols of prosperity and the reality of people's lives, that's where the unease comes from. Not ideology and not economics, just lived experience. And there's the thing we seem to have forgotten. The point of an economy is human flourishing. That's it. No stock indexes, not quarterly earnings, not market freedom for its own sake. It's about health, children, family, friends, your home, your place in the community. It's about people. If the system doesn't support those things, if we can't even centre those things, then exactly what are we doing?